Last, and someone very familiar to many of you, because she's been here many times. I'm sure she gets re-invited because of her soft-spoken and non-opinionated way of addressing what's going on in healthcare. But Sheryl, who has been in Wall Street, doctor of economics for 28 years, your bio says, and is well-known, well-respected as a keen observer of what's happening in our healthcare world. Thank you, Sheryl.
Okay, good morning, everyone. So, you know, this actually gets harder and harder to do every year unless the faces kind of change at the conference. We pretty much get the same cadence and the same themes every year. So I really want to thank Margaret and Paul for changing things up because it gives me new fodder for this speech. And I also, by the way, will take time now to say yet another fabulous conference chock full of really interesting, perhaps controversial, perhaps completely, absolutely wrong. Joe's in the front row. And information that you've been given and insights, and I think, you know, some really good forecasts about what can and should and probably will be happening in our healthcare, broader healthcare industry and in the politics and regulations that are so important and so integral to it. So congratulations on yet another phenomenal conference. 25 years of phenomenal conferences is, I think, a world record. I think our years would be less fulsome. Certainly my work would be more difficult if I didn't have the benefit of the insights of all of my fellow presenters up here, and made possible by two really phenomenal people, Margaret and Paul. So thank you, and a huge round of applause. And somehow they both do it and look younger every year. Okay, so you're not going to get Lady Gaga, and thank goodness you're not going to get Donald Trump, but you might get Betty Davis. Fasten your seatbelts. You're in for a bumpy night. So let's go back to 2015 and see what happened. So last year when I was here, we were setting off the champagne corks. Things started to get a little bit dicey come the second quarter, and I had to reach for the aspirin. By the time the third quarter rolled around, I needed to reach for the ice bag. And then by the time the fourth quarter rolled around, the storm clouds were clearly coming in fast and furiously on the horizon. Things are not looking so good in Wall Street land. So what happened? Well, let's see. We started off with huge upside, excitement, surprise about the volumes in the fourth quarter of 2014 being driven to near all-time highs as a result of having more paying heads in the beds. Thank you very much, Congress, for passing the ACA. Reform is good for hospitals, therefore buy hospitals. And you can see that that was pretty much the theme even through the King v. Burwell decision in June. People were still pretty optimistic about the hospitals. I was a little bit more cautious. I kind of liked HCA. I was saying I'd marry HCA for the money, but I'd really rather, you know, on occasion I would date Tenet, but I'd really rather marry HCA for the money because they make so much that they'd keep me accustomed in the style to which I'd become accustomed well into my old age. And the rest of them not so much. But then in August, we had a really, really, really bad shock to the stock market. And let's see, is it that? Yeah, so this is the part that I'm talking about right here. Whenever you see this in a chart, this means people lose their jobs. And except that this time it wasn't the US market that was controlling it, it was China. And I know, so this is kind of interesting. You get the optimist at the beginning and you get the pessimist, the cynic at the end. I mean, this is a very well-balanced conference. So, you know, as Jim would tell you, you know, gee, maybe it's really not China or that we've got China wrong. And I have to go home and think about that because Jim may actually be right for this time. But be that as it may, the U.S. is the tail wagging this dog because the U.S. equity market believes that's the case, if for no other reason. And companies like HCA, which have, well, the company itself has little to do with China, even though the Frist family is very much interested in bringing healthcare U.S. style to China, that had nothing to do with it. And that U.S. healthcare companies, generally speaking, had nothing to do with China. But currency fluctuations and slowdown in growth or perceived slowdown in growth of one of the world's largest economies that, drives our engine, certainly, our stock market engine in many ways, was a real problem. So the green line that you see there is actually the green line is the S&P 500 index, and this line is an exchange-traded fund for healthcare services that the S&P puts out and tracks. Okay, so that's that slide. So as you can see, the second half of the year, the market well outperformed the broader market outperformed the specific healthcare index. Okay, now it was actually worse for some than for others. So this one is a chart of specifically our friends at Community. This is a topic, the topic here is consolidation, so talk about failed consolidations. We're going to officially name here today the acquisition of Health Management Associates is a failed consolidation play by Community Health Systems. It was a mess, it is a mess, it's going to stay a mess for a very long time. But they borrowed a lot of money to do it, and they're no longer generating as much free cash flow as they thought, meaning they are in deep doo-doo trouble. And that's my professional opinion accompanied by a sell rating. So full disclosure, this is the rest of the S&P. It's going up nicely. Whenever you see a break like this, that's not good news. That was a big miss in the third quarter. What's not on this chart is the news that, thank goodness, they released on Monday instead of on Wednesday, so I could actually see the second panel yesterday, was their fourth quarter numbers, which were yet another unmitigated disaster where they're having a significant cash leakage problem. That raises all kinds of interesting questions that I won't go into here. And then there were, of course, others, and this is mostly focused on the hospitals, but I can tell you the health plans didn't have a great time of things either, and they're not trading anywhere near their acquisition values. But here you got Tenet, which actually, poor little Tenet, actually didn't do so badly in the third quarter. They actually had a pretty good third quarter, but since HCA missed, and which is unusual, and Community missed, which is maybe not so unusual, but it's the first time the market took them to task for it, they had a little bit of an issue here in October. But the fact of the matter is their stock price is going down because their leverage is high and people are losing confidence in the hospital industry, and highly levered equities tend to trade at higher implicit valuations, so the stock keeps looking expensive even as it goes down, whereas the broader market recovered. Okay, so that's the sad tale at the end of the year. So the question is why? Well, as I mentioned, China is an issue, and then you have the miss by HCA. A week later, Community missed, and frankly, that's when I should have gone from a buy to a sell, but that tends to make management teams and more importantly, investors not like you very much, and I was kind of in the mood of, gee, I think this year I want to be liked. Let me try that out for a change, as a change in strategy. It doesn't work. So I'm back to a sell rating. I feel much better. Okay. None of the stocks have yet recovered, nor will they for a while, except because now Community, even though HCA blew the pants off its estimates and consensus for the fourth quarter, did a really great job coming back from what was some labor cost headwinds, some payer mix headwinds, which is typical for them. Really what I think it actually was, and I've said this to them, so it's okay if I say it in public, I think it was hubris. I think they just got too full of themselves. We're HCA, we're big, we do everything great. This is a lesson to all of you out there who are doing really well. Look behind you, somebody's coming. And in this case, it was some labor costs and some contract labor issues that really bit them. And then it was just cemented when Community reported. But the thing about HCA is they've got the people and the depth of the systems and a lot of other assets that they can pull in and do a whole lot better, not the least of which is the best managed care pricing in the nation and the ability to get more. So that was that. But hospitals weren't the only one having the tough time. I apologize for the tiny little writing, but what I'm trying to tell you here is we pay attention to a lot of the things that the folks in Washington do. We pay a lot of attention to on Wall Street. Sometimes we pay such good attention we even announce it before CMS does, which is a really bad thing. But in any event, what happened here was that the world of post-acute care has been turned on its head. And this really has ramifications for everybody. It has ramifications for obviously the skilled nursing facilities, obviously the home health facilities, long-term acute care hospitals, inpatient rehab facilities. So all of those of you who are in the hospital business, who are filling beds by having acute rehab units or skilled nursing units, you better think twice about deploying capital there. And the reason why is bundling is here. okay? When I first wrote this report, bundling was coming. There's some really outstanding data. Just 1 quarter's worth of data from BPCI was enough to convince this new CMS that they needed to go mandatory and large for hips and knees and bundled payments in 65 markets. It starts April 1. The early data tells you that instead of sending 66 out of every 100 patients to a skilled nursing, Medicare patients, to a skilled nursing facility after a hip or knee replacement, you're now going to send 44, okay? Let's see, 22 fewer on 66. Sounds like a third, okay? 33% decline. Sounds that way, all right? Then the next piece of this is, where are those patients going? Well, gee, there's some rationality here. They're going to home health. Now, that's a whole nother kettle of fish, because some things in home health still aren't wrapped too tightly and maybe not especially compliant. But the fact of the matter is, you're taking a $600 to $900 a day case, and you're swapping it out for a $150 a day case, and a hospital who's at risk for bundling is going to do that every day, all day long. And they're not going to wait for bundled payments. They're going to start doing it now because their DRG payment hasn't changed. And in fact, they're not only going to do it in the 65 markets in which they're bundled, but if they have hospitals in other markets, it's no skin off their nose. They're going to do it elsewhere. How do I know this? Because there's a really interesting system called Northwell, which is the former North Shore LIJ, which is a BPCI participant, who told me this. This is already what they're doing. They've cannibalized their own skilled nursing facilities, their own inpatient rehab facilities, in order to save the system money, because they know ultimately it will cost them money if they don't train their doctors, their nurses, their discharge planners, their case managers to do this now. So what Barry said, don't wait. Don't wait for post-acute change to come. Don't wait for value-based payments to come. Don't wait for population health and all of the things that are putting you at risk to come. Because it's coming, it's here, and if Andy Slavitt is half the man I think he is, he's not waiting for the rest of us to catch up. So that's the topic of the day, is consolidation, and I'm trying to move quickly because I want to talk about some of the things we talked about here, but I do have an obligation to talk about consolidation. So to understand where we're going, you're going to have to ask the question, why do we start the journey in the first place? You've heard all of this. Okay, I'm going to add to this the external catalysts. Specifically, what I like to call in healthcare services, the whacks upside the head that keep me employed for 28 years talking about healthcare. Thank you, guys. I appreciate it. Okay? So what happens here is you get legislation, you get policy change. When you have methodology change, systems in healthcare cannot deal with that right away. They seize up. When the method changes, it has the single, that's really dangerous for the companies that I cover. They can all mitigate the rate changes. But when the rules of the game change, you get a year or two of significant dislocation in the business. And that often makes, and if they know it's coming, the first reaction is, I got to get bigger. I have to have more scale. I have to be a lower cost provider. And, you know, if you were a nursing home coming out of BBA 97, looking at prospective payments staring you in the face, and looking at a blended phase-in over 4 years that paid you more if you were higher cost in the beginning, you went out and bought every single highest cost facility you could, and 13 publicly traded companies went down to 1 or 2 publicly traded companies, and the rest of them went bankrupt when the chickens came home to roost. Okay? So external whacks have a huge impact on how companies perform, and a huge impact in how our healthcare system performs. And lead to a lot of consolidation, but not necessarily the kind of consolidation we're talking about here. And then, of course, you have the response to the population growth and decline issues, which, remember, hospital volumes closely tied to population growth across most of the United States. Most hospitals are still in the business of growing volumes, so that's an important factor. And you've heard about all of the rest of this. And I'm going to add this, protecting the flank. So, you know, these companies that merge are run by human beings. They're not run by robots, they're run by human beings, with the normal things that affect them, the fears that they have, the vision that they may or may not have, the leadership that they may not have. A lot of times, you actually do get a leader who looks out into the future and says, you know, at some point in time, XYZ company or XYZ service is going to attack my flank. I'm going to lose market share because of that. So let me do a preemptive move or a reactive move because the attack has already started. So, you know, there's probably a reason why Optum has acquired so many, as an example, so many little tiny IT companies, because in part they had disruptive technology that they could use, and in part they had technology that they didn't want anybody else to get. Okay? So when you're big and you got a ton of cash flow, another company I also have a buy rating on because they, you know, see the theme here? They have money, they can take care of me. Okay. But protecting the flank and building an empire, which speaks to the CEO ego, boy, is that ever true. You have no idea sometimes the complicating factors that come up with companies because of CEO ego. But I'm going to talk about the real reasons here today, which you might have a sense of are fear and greed. Okay, these are really the only two reasons I could really come up with as to why entities merge. They either are afraid that if they don't, they'll lose, or they're greedy enough to know that if they do, they'll make more money. But apart from that, there really aren't any other reasons why. So let's talk about some of these traditional consolidations. Aetna, Humana, it's the second half, 2016. Betting is that Aetna, Humana does get done. Anthem, Cigna doesn't get done. The reason is it's really easy to satisfy antitrust with Aetna, Humana. It's just local market overlap. You sell off some licenses, you repackage some lives to somebody else, and they're reasonable lives, and somebody will buy them from you. Anthem, Cigna is a national accounts overlap for the most part, and there's much more worry about not being able to find a way to satisfy that overlap from an antitrust perspective. And those of you who don't remember, I used to be an antitrust economist for the Department of Justice, so I might, even though it was a long time ago, more than 28 years ago, I might remember a thing or two here. And then the other issue here is that as far as the one thing the stock market had, and I don't know if any of you have heard this, but when these deals were first being rumored, and by the way, it was disgusting, they were negotiated in an open marketplace. Those CEOs who were negotiating price in an open market, their board should take them out and shoot them, my opinion. Okay? How could you possibly be doing anything in the best interest of your shareholder, negotiating, saying, I want to buy X, and then end up buying X, but someone else in the meantime says, no, I want to buy X. I mean, you know, the prices just kept going like this. Naturally, when you do a negotiation, keep it in the boardroom, guys. You know, CEO leadership lesson number 101. Anyway, besides that, so one of the things that came out, you know, we were all trying to figure out why do they feel this compelling need to do it now? And the obvious answer is scale and this and that. You know, United Envy is another thesis here. But the thing that troubled me was that the administration wanted health reform to pass, and as part of that was sending a signal to the health plan industry to consolidate. I think the only signal that the health plan industry was sending to that the White House was sending, or the administration was sending to the health plan industry, was bang, bang, we got you. It was much more of an issue of you're the bad guys, you're in our sights, and we're going to regulate the daylights out of you. I mean, think about what happened to the health plans. They have no control over their medical loss ratios anymore, not commercial, not Medicare Advantage, not Medicare, not Medicaid, okay? They have taxes on their premiums, which may or may not stay. There have been some changes, clearly. May or may not be a good idea. There's all kinds of fees that they've paid. They've lost control over their ability to raise premium, because if it's over 10%, they have to go ask Mother May I in most states. And certainly they've got a complicated, soon to come out, advance notice coming on Medicare Advantage rates that is as regulated as it can possibly get. So they have no degrees of freedom. Where do they get to price their product in an open marketplace? They don't. Look at the things that they gave up. And, oh, by the way, never mind that, they have an unlimited risk with open-ended benefits every time somebody buys insurance now. You can't put there's no lifetime cap on benefits. So they can pay and pay and pay and pay, but they're essentially regulated up the wazoo on the revenue side, and they're regulated up the wazoo on how much they have to spend. This is not your mother's managed care profitable organization anymore. This is a very different real live world. So as far as this, the administration wants this to happen. More competitors on the exchange is a good thing. Fewer competitors on the exchange is a bad thing. So if the administration wants more competitors on the exchange, this consolidation is not a good thing. Then you have post-acute consolidations, and these are and in the acute care. So I've spoken to the community acquisition of Health Management Associates. You also had Tenet acquire United Surgical Partners. Okay, so they desperately needed outpatient exposure. They had the least of anyone. They did sort of a time payment, almost a layaway type acquisition strategy with the private equity owner of USPI, and that, I think, actually was a pretty smart deal because it's nicely accretive. They get to pay it out over time, assuming they have cash flow and they survive this near-term crunch. And they get a whole lot more relationships with not-for-profit hospitals and new markets, as well as in existing markets that could be interesting. Kindred acquired Gentiva, and this is very, very important as far as the post-acute and bundling situation, in theory at least. They didn't have exposure to home health, but they sure did have a whole lot of exposure to skilled nursing, to long-term acute care, which has got a change in admission criteria coming in that already started for some, but for them it comes next year. So there's lots of things going on there, but again, remember what I said. They're giving up every day they lose in a skilled nursing facility at $600 a day. Every day they gain in home health, it's $150 a day. How many days do you need of home health to just break even with subacute care? By the way, if you understand this, you're smarter than most of the portfolio managers on Wall Street who own Kindred. Health South saw what was going on and finally decided that they needed to be something other than just an inpatient rehab facility operator. They bought Encompass Home Health in January of last year. They bought Care South, which had to have been designed with the Health South acquisition in mind. You only have to change one word of the name of the company. And then they bought Reliant, which was in the post-acute business of providing inpatient rehab facilities. Now, this is actually kind of interesting. So when you see these kind of group associations merging, you really got to wonder what's going on. But the VHA joined with UHC. VHA runs Novation, the big group purchasing organization. MedAssets ran into trouble. Activists got involved, forced the sale of the company, and the GPO business went to Novation, which is probably where it should have gone a long time ago. So let's talk about the fear factor. You know, when you get OBRA 87, then BBA 97 10 years later, and then you get BIPA and BCRA and the MMA of 03, and then the ACA of 2010, there's lots of regulations in there that cause a lot of fear, okay? And then when you're finished moving through the fear, the greed takes over. But what happens is that we're used to those shocks, but we're not used to seeing the public and private sector shocks coming simultaneously, at least not in hospital land. By the way, I work for a Japanese bank, so that was kind of in homage with sadness to the tidal wave. It is. And they haven't recovered yet completely from there. It's really rather awful. But an unprecedented space and scope of change of reimbursement policy and methodology changes is striking the post-acute and then the acute care industry, and by extension, the payers who will be working with what's left. This pace of change we have never seen. It used to take 17 years to implement best practices in healthcare. Okay, 17 years. We all should be ashamed of ourselves. Even before the ACA, there was a push to make patients' observations versus admissions highly controversial, lots of negative outcomes for the patients themselves who, hey, I was in a hospital bed, isn't my nursing home stay covered? We get that, okay? But nevertheless, what is a hospital admission is a really good question. So there were all kinds of things that were going on. But if you think about what's happened now, we've got ACOs, Medicaid medical homes, we've got readmission cuts, we've got value-based payments are spreading into post-acute care finally. We've got LTAC criteria, we've got reimbursement cuts and rebasing in the home health sector, which, by the way, they're still making plenty of money because it was a rate cut, not a methodology change. We're now having some conversations about the change to the hospice payments, so that this U-shaped reimbursement situation that might help address some very long stay issues in the hospice business. And then we've got bundling and for the BPCI and the CJR. And literally in February of last year, they got the first report from the Lewin Group on the impact and results of the BPCI, and by May, CMS was already making it mandatory in 65 and proposed 75 markets. I've never seen that. In 28 years of covering healthcare stocks, I have never seen that rapid a pace of change. And I think this is a hallmark of things to come. That, if they're going to make that 2018 deadline, which, by the way, I now believe is absolutely real and irrespective of which administration is in, because saving money in Medicare is what everybody wants, and paying the right way is what everybody wants, even if they don't admit that they agree on anything, I think that's really going to happen. So in almost 6 years, CMS has implemented 65 programs. Not all of them have been successful. Some of them have been stopped, that aim at reducing utilization. And then you pile on some more. Now you've got activist managed care companies who are getting in between the patient and provider decision about where you get your care, making sure you get a second opinion, making sure you go to the center of excellence, making sure that you get the right care at the right time for the right price. And the answer is, you all have the handout, the answer is that when you see somebody saying, right care, right time, right place, if you operate a company that is dependent on facility occupancy for your revenue, you are in deep trouble. Everybody out there has laser sights on getting patients out of facility beds. And if you're a hospital operator right now, step back. When I last addressed a large group, it was a large group of CEOs of large not-for-profit hospital systems. And I was among several people who are outsiders to the industry, although I sort of consider myself an insider, mostly consultants, who would ask the following question, as I did. So, for the hospital operators in the room, how many of you had your best year ever in 2015? And every CEO in this room raised their hand, okay? How many of you are building beds? And all but one, 59 out of 60, raised their hands. And that one guy runs a system that's going to survive. Because what will happen going forward is that there will be an excess of beds. Those beds will be emptied out. But I understand why they want to build, because what they see right now is a ton of new patients. No pay went to some pay, and in some case profitable pay as a result of the ACA. And they're seeing new opportunities because they can invest, those that are successful can invest their cash flow in their markets. And they're just overflowing with success in 2015. It's really, really, really hard to invest in a challenging future and take those hard steps when you are mired in a particularly pleasant present. So, now, I'm going to, since you all have this, I'm going to step back and do what you really want me to do, which I'm going to try to find a way now that we have an online version of these presentations. The challenge I face in giving this talk every year is that when I sit in the audience, there are so many things I'd really like to put up on the slides afterwards that I can't, that I know you all want me to react to. So, but, Margaret asked me for a presentation at the beginning of February, the middle of February, and she's patient as can be because I try to push it as close as I can so that I can give you sort of the most timely or insightful things that I can possibly give the group. And it's not always, as therefore up to the minute and certainly as reflective of some of the things that I heard at the conference to be the wrap-up speaker. So I'm going to step back now and I'm going to be the wrap-up speaker rather than talk about consolidation, okay? So the first thing is on exchanges. I have to reflect on something. Thank goodness someone put the quote up from Peter Lee about United. So let me just tell you what happened with United. United, in the middle of the fourth quarter, made a stunning announcement that it was taking about a $750 million reserve against losses on the exchange and some Medicaid contracts that were going to lose them money as a result of the expansion of Medicaid. And the reason that they cited was that 60% of their members by the beginning of December came to them through special enrollment periods, and that these people had many, many, many multiples higher expense levels than people who were with them from the beginning, who were good, solid citizens with respect to exchange-based products and bought it during open enrollment and stayed insured through the year, who you think about are probably the sicker, more consistently sick patients who wanted to buy that insurance. And the problem is that these people can move in and out, and it's a great deal. And I'm sure there's some brokers out there who were making a ton of money going out and finding clients who would, attest to the fact that they had lost their jobs or had a life situation change that made them eligible for a special enrollment period. They could go in, sign up, get everything taken care of, and then, terminate their coverage. You're in for a month, 2 months, 3 months, and you're out. Greatest thing since sliced bread. It's also not insurance. And it wreaks real havoc with the insurance pool. And so, the code words that United likes to use is it's not broad and it's not balanced. The fact of the matter is there's too many sick people and there's too many people gaming the system. So ask why. So it turns out that in the individual, identical type products, the equivalent products, United and other payers can actually ask for documentation. They can actually say, oh, you lost your job? All right, did you file unemployment insurance? Can we see something? Can we have some proof that you actually lost your job? And if you don't get proof, you don't get covered, okay? So they trust and they verify. CMS seems to only want to trust. Gee, I thought the government was really good at trust but verify, but maybe we want to rethink that. The bottom line is that you have a completely unstable insurance pool. Now, stepping back from that for a second, that caused a tremendous amount of controversy because United said, look, we're going to back away from our 16 commitment. They actually were foolish enough to expand their presence on the exchanges. We're going to back away from that. We're not going to pay our brokers. And actually, as it turns out, when they reported the fourth quarter, as they said, they were going to try to avoid the losses. That's a good thing because the losses were already up to $1 billion. Okay? Now, United may not be the best individual market operator in the world, but they're not complete idiots, all right? So assigning the blame among all of the various points of blame, the fact of the matter is that you got a huge, sophisticated, data-driven health plan that can't make a go of it on the exchange. On top of that, you've got the co-ops in New York who couldn't make a go of it. And then you had United, you had the Aetnas and the Anthems while all of this was still in the fourth quarter, poking fun at United saying, oh, we can make this work, we can make this work. And then when they reported, you saw it, that they actually couldn't. But Peter Lee basically came out there and said, as you saw the quote yesterday, saying, oh, United, stop the sour grapes, don't blame it on the exchanges, blah, blah, blah. So let's just set something straight here. One of the things that United didn't do was get involved in the California exchange. That was probably a mistake because those who've been involved in the exchange have had it much better, including Anthem, than those who've been involved in other exchanges. But I have to wonder how much of the fact that just blatantly ignoring that the federal exchanges do not have the tight rules around no grandfathered plans and none of this manipulation of the special enrollment period, whereas California may have better controls and certainly is paying, I think, more attention to that. That's a very big difference. So I have to wonder how much of this was sour grapes that the nation's largest health plan decided to avoid California. And somebody who knows him can inform me on that score. But the fact of the matter is it was $1 billion loss, Joe, so you might want to update your slide. It was $1 billion loss on the exchanges. Huh? It's over 2 years. For 2015 and 2016, over 2 years, $1 billion loss. And no, they won't be there in 2017 unless things change a lot. So then I'm going to work on this question of the mandate. So I don't know. I'm going to say this again. Continuous coverage provision. Let's see. So we give people a choice. They either stay continually covered or they pay a fine. Let's see. We tell them you have to buy insurance, and if you don't, we pay a fine. Big difference. To me, I got to tell you, I thought it was really interesting yesterday when I made that comment. I actually felt a little strange calling out a distinguished speaker, someone who clearly knows a whole lot more about healthcare than I do, and certainly a lot more about politics than I do on this issue. But I must say, as a citizen of the United States, that I am appalled at how stupid these people think all of us are, to not be able to understand that when you hear a mandate, it's a mandate, and there is no difference. And to understand the manipulation that is going on of the American opinion of something that ultimately the party itself is terrified of repealing because their own members are using it. I mean, think about the implication of that statement, that they can't do repeal anymore. Now they have to do replace. They're admitting defeat yet again, but they're not going to call it defeat. And instead what they're doing is further dividing the populace and enabling the emergence, as you heard yesterday from Norm, enabling the emergence of people we, frankly, should be embarrassed to have running to be leaders of our nation, in my opinion, separate and apart from anything that has to do with Wall Street. And I'm sitting here and I'm listening to this nonsense that people are being fed. And it's the same thing every time. The Democrats are not mounting an effective, reasonable, consistent, persistent, passionate campaign to advocate for the thing that is the centerpiece of the administration's work in the last 8 years. It boggles my mind. Is the ACA perfect? No, it is not. Do the Democrats want to change it? Of course they do. Will the Republicans ever let them? No, they won't. Because people don't identify themselves as Democrats or Republicans when they're in the hospital. They identify themselves as patients when they're in the hospital. They identify themselves as patients who can either afford the care that they have or can't afford it. And when they're given something that helps them to afford it, they like it. Take the politics out of it, that's what you have. And when you have a situation that we have now where we've politicized what is fundamentally something that has nothing to do with politics and everything to do with you being a human being, we end up in the situation that we are now. So people are no longer Americans in Washington. They are Republicans and they are Democrats. So I was asked yesterday by the gentleman who apparently was taken aback by my calling out from the crowd, for which I apologize. Who are you? I'm sorry, who are you was the question that I got. So let me tell you who I am. So first of all, I am the director of research for a global financial services institution called Mizuho Financial Group, and I am director of research for Mizuho Securities USA. Mizuho Securities USA is a division of a large Japanese bank. We are expanding rapidly in the US in concert with our partners in Japan and Tokyo. We expect to become a very important part of the US investment community by bringing very high quality research, very high touch client service, and very efficient and effective execution to all of our institutional clients, both here and abroad. I have also been a healthcare services analyst for 28 years, and I hope that it's been more than just 1 year of experience 28 times over. I am therefore, I have covered hospitals, I have covered health plans, I have covered post-acute, I have covered e-health, I have covered the health internet, I have been a rock star analyst, I have covered a little bit on physician groups and a whole lot on post-acute and nursing homes and IT and everything else. I am also a capitalist. So what all of that makes me is a financial policy and something of a political interpreter, potentially even an expert when it comes to health care. Otherwise, I don't think you'd really want me to be up here. I know I'm entertaining. I am also a thinking, rational, ethical person, at least I certainly try to be. I'm always held accountable to my clients and to my family for the decisions that I make. And however, I am also, I think, at least I try to be, a decisive person, one who tries to take into account the best interests of all of the constituencies and the people for whom I am responsible. But I try to be passionate about my work and about my family and about my life. I try to be effective, and I try, on occasion, not to be offensive. But let me tell you what I am not. I am not a Republican. And despite what it says on my voter registration card, there's an asterisk here, I'll explain why it says this, I am not a Democrat. I am, however, a compassionate, rational, and I hope thoughtful and knowledgeable American who cares what happens to the guy next door. Thank you.
As I said, non-opinionated and soft-spoken. Thank you, Sheryl. As always, very, very informative and interesting. We have about 5 minutes while you're assembling to ask questions. I'll do quick off-topic. Barry, would you pay $17,000 in Bitcoins to unlock your computer system?
It's a shockingly small number, but I don't think so. It's amazing.
That is precedent-setting and very confusing to all of us in healthcare and cybersecurity. Can we get some questions? Does anyone have any? I can kick off if not. So what we did not hear, I didn't hear a whole lot from our economists on the panel, was how much of this growth and consolidation is due to very inexpensive capital and the fact that they need to deploy it and it costs almost bupkis to do so.
You want me to take that? Yeah.
Sure,
Okay.
whoever.
Sure, sorry. So a lot, obviously, when capital is cheap, which it, for a lot of people right now is not so cheap, at least on the debt capital side, there's been some real dislocation in the fixed income market as a result of currencies in China and interest rates going up and a little bit of lack of confidence in the Fed and things like that. So it's been a little bit more challenging now, but yeah, I mean, you know, for the last, going back to, let's call it 2011, debt capital's been almost free. I mean, the debt capital markets really haven't been pricing risk in effectively for a very long time. It almost reverted back to the pre-crisis levels of lack of pricing in of risk almost immediately. And then on top of that, you know, a lot of these companies were very successful and they have, you know, fairly high cash flows. But I think that what we are seeing, for example, in one of the things we didn't talk about is in the pharmaceutical and specialty pharmaceutical area, where we saw very significant transactions with Allergan, and interesting and controversial, with Allergan being the target of a couple of companies, Valiant and Actavis, and then ultimately going with Actavis or Activus. And now it's become Allergan again, and now Allergan's going to be merging with Pfizer, but not before it sells off its generics to Teva. And so, you know, those kinds of transactions could not have happened without a very, very cooperative set of capital markets.
Okay, thank you. I believe, it's hard to see here, but I believe we have a question up on the left. Yes, sir.
Hi, Howard Kahn.
Oh, hi, Howard.
First off, hi, Bob. I've never thought of Pfizer as a biblical name, but as you just started describing that, it sounded like a biblical story, Sheryl, as you started talking about all the different begetting, and trading off. I guess I have a question about the consolidations in terms of both the providers and in terms of the health plans going forward, because you all talked about what's been happening. But I think it's really interesting to think about what's going to happen now that we've had studies that have said, you know, consolidations on the provider side haven't been so beneficial so far. So let's keep doing it. Is that where we're going to be heading, do we think? So I just love some comments about consolidations going forward at this point.
Go for
I
it.
think it will likely vary by market, depending upon how consolidated the market is already. So if we look at the market we're sitting in today, it's always been a bit of an anomaly from a California perspective. I mean, if you look at the big integrated health systems, in San Diego County, there are effectively 3 that you need to deal with if you are a employer or a payer. In Northern California, there are 3 if you're an employer or a payer. In the Orange County, LA County, Inland area, there's a cast of thousands. Now, certainly the Providence St. Joe transaction is stimulating a lot of activity, so I think we'll see an increase in consolidation in this market, to be sure.
I'd say generally across the country, we're going to continue to see consolidation both on the payer and provider side. I think there's no stopping in sight.
So I'll just add one thing. Whether or not you have consolidation by company buying company or entity buying entity, you're going to have consolidation through the other way, which is the thing you should be afraid of, which is beds are going to close and entities are going to close, and those beds will be reallocated to where the population shifts, or those services will spring up as being outpatient or home-based or some other thing that technology will enable. But you know, what we don't typically talk about in these consolidations, which was part of the presentation I didn't do, which is that you're going to see things consolidate, as in the entity not merging, closing, and getting smaller. If these entities don't take steps now, as Memorial Care has done, to prepare for life in the future when that top line that you're used to getting now has very different incentives, where you'll actually be penalized for behaving in a fee-for-service way.
Yeah, I can't overestimate the importance of that. We have 3 beds per 1,000 in this country. You need a bed and a half, right? That's the reality of it. And so, you know, in a 2-hospital system town, which is what a lot of Middle America looks like, one of them should go out of business. And that's often the largest employer in that town, right? That's often a big contributor to local politics and to the local community. I mean, I think if we get to a rational system, if we get to a system that delivers the kind of care 30 years of evidence-based medicine show us we should be delivering, we should have 1 out of 2 systems in a lot of towns going out of business.
I think we have a little bit of a long horizon to see that happen because of the creeping of evidence-based medicine. I think we talked about that. I think it is going quicker, but it's not going as quick as you might think. There's a lot of language around it, a lot of talking around it. It's happening in pockets, but when you really get into the systems and see what they're calling evidence-based medicine, it's really not that yet. So I think that there's a caveat there. I would say with the Catholic systems, it's been very interesting because, you know, if you look back over the last couple of decades, they were very reticent ever to close a Catholic hospital. The Archdiocese would just not allow it, no matter how small or inefficient they were, and that is clearly changing. They're starting to almost sort of dump hospitals. I mean, they're just moving away from them, changing names of systems and, you know, doing all kinds of consolidation. So I think that, you know, when you look at over 5,000 hospitals in the country and 2,500 of them are in 200 systems, then we understand that there's already significant consolidation, and that will continue in both lanes with people merging and acquiring and also closing unprofitable hospitals, which actually you mentioned.
Thanks. I think we have time for one more. Cindy, you are on. We always want to hear from Cindy Ennis.
Actually, probably not. But one of my biggest concerns is where are the payers in terms of really supporting all of these moves to value-based care? I mean, I just don't see the deep penetration of value-based payments that really reimburse the provider systems for providing one level of care to all patients, which is truly integrated care. Barry spoke to that there's only one standard of medicine, really, and that is to give everybody that optimal care. So how do you get the payers to take that accountability for really investing in the system to help providers reach the macro goals and CMS's goals?
Yeah, I mean, I think this could be a very long conversation. We shouldn't, I think what Barry said is absolutely right. We should never forget that the single largest payer in the country is the federal government, and they have a very different set of incentives than all the other payers. I think they have a real set of incentives to drive to value, and they're trying to do these experiments across the country. I think all the other payers, they don't want to drive to value, they want to drive to sustainable profitability. And if it works, what CMS is doing works, they will follow and mirror it, because it'll take the costs out and allow them to maintain profitability. And if it doesn't, they'll figure out something else. But we've got one organization that's really trying to move to value and one that's just trying to stay alive. And I think we should think about those as very different things.
Okay, thank you.
Yeah.
Are we, one last.
From a payer perspective, I think, first of all, value-based payments are not easy to do. They're not easy to come up with, they're not easy to implement. Generally across this country, Generally across the country, we don't even know what the actual total cost of care is in almost any situation. So value-based payments are not easy to come up with. It's not an easy methodology. I want to make that very clear again. A lot of language, a lot of buzzwords, a lot of talk about this that makes it seem like we're just ready to do this and payers and providers just don't want to do it. That's not the case. And I think that payers would find value in it, quite frankly, actually more than providers in many cases. But, you know, in surgery, orthopedics, and areas where it's easier to quantify costs, that's where we're seeing it, right? We're starting to see it in procedural type events. But when you talk about chronic care and diabetes and cardiac services and, you know, mental health, it becomes much more difficult to quantify first. And then you have to think about, you're going to pay an entity to do a certain amount of care, like a capitation, back with the dirty word again. And then at the end of the day, you have to distribute that money. And the distribution model is a whole nother area where we're very weak on both sides, payer and provider.
Well, thank you, everyone. Let's give this panel a hand. And thanks again to Margaret and Paul for a great conference. Let me turn it over to Paul for concluding comments.
Excuse me, this will be very brief. Just want to make a couple, this will be very brief. I'd like first to introduce Murray Jacobson, who is a health economics professor at the Paul Merard School of Business and is also director of our Center for Healthcare Policy and Management. And Murray would like to say something.
Hi, I have big shoes to fill for all the next conferences. So I want to actually really say thank you to Margaret and Paul for all these years of great conferences. I've only had the pleasure of attending the last few, and they never disappoint. Margaret, at the beginning of the conference, I believe they described an effort to name a room for Paul in his honor for all the great work he's done at UCI as well as at this conference. So Paul and I have something very small for Margaret to show our appreciation for her great work over these last 25 years. So Margaret, please come down. She really is the genius behind all of this.
Oh my goodness, it's heavy. Wow. Thank you. You're welcome. Let me just say a word of thanks. Thank you, everybody, so much. I appreciate all of you, our sponsors, our speakers, our attendees. It is really, really like a family reunion every time we get together. And let's keep this one going, okay? Thank you.